Your home insurance company can drop your neighborhood, legally, overnight. 16 insurers already gone under in Florida. 16 more just walked away. The safety net behind them? A state plan now covering nearly 700,000 homes it was never built to handle. And it's not just Florida anymore. I build financial models for a living. Let's look at what's actually happening to the policy in your filing cabinet. System 1. The retreat. Your home insurance company can legally decide your neighborhood is too risky and simply stop selling policies there. It's happening at scale. In Florida alone, 16 insurers have gone insolvent, and 16 more have withdrawn entirely since 2017. When private insurers leave, homeowners get pushed to a state-backed insurer of last resort, coverage designed to be temporary, not a real safety net. California's FAIR Plan now covers almost 700,000 homes, a 157% increase in under 4 years. That's not a niche program anymore. That's the backbone holding up an entire state's housing market. And FAIR Plan coverage is thinner than a standard policy, often missing protection a private insurer would have included.
System 2. The risk pool trap. Your premium isn't really about you. It's about your zip code. Insurers price a whole risk pool together. Your rate can jump even with a perfectly clean claims history because your neighbors filed claims. A third of zip codes nationwide saw premiums rise more than 30% between 2021 and 2024, according to consumer researchers. Minnesota's up 34% in a single year. Colorado, 33%. 6 states crossed 20% in the same 12 months. You can have a spotless record and still get priced out because the pool you're in got riskier around you. Shopping for a lower rate helps. It doesn't fix the pool you're standing in.
System number 3. The silent coverage cut.
Faced with premiums up 46% since 2021, 3 times inflation, most people don't cancel insurance. They quietly shrink it. Raise your deductible. Trim optional coverage. Insure the home for less than it would actually cost to rebuild. Each choice feels reasonable in the moment. It lowers the bill you see every month. It also lowers the payout the 1 month you'd actually need it. Underinsurance doesn't show up on any statement. It shows up after the disaster, in the gap between what you're owed and what it costs to rebuild. The policy still says insured. The math underneath it quietly changed.
Stack it. Insurers are retreating from the riskiest areas, leaving people on thinner last resort coverage. The risk pool prices you by your neighbors, not just your own record. And rising premiums are quietly pushing people toward less coverage, not more caution. None of this shows up as one dramatic event. It shows up as a policy renewal that's a little higher, a little thinner, every single year. By the time most people notice the gap, it's the week they need the payout most. Here's the fix. 3 things worth checking today, not after a disaster. Rule 1. Check if your insurer has reduced exposure or downgraded in your state. Public insurance department filings are searchable and free. Rule 2. Ask what actually lowers your risk pool pricing. Roof age, mitigation upgrades, and building materials often matter more than your personal claims history. Rule 3. Audit your dwelling coverage against a real rebuild cost estimate, not the number you set years ago. Construction costs have climbed faster than most policies updated. Cheaper isn't the goal. Accurately covered is. I built a free spreadsheet, the Home Insurance Coverage Gap Calculator. Plug in your current dwelling coverage and an estimated rebuild cost, and it shows you the real gap, in dollars, before a disaster does. Link is below. Subscribe for more.